Yeah, good day everyone. So we're going to be solving an extensive question on absorption. Yeah, so I'd like us to read the question first. A Associate is a partnership business which absorbed A Associate on 1st January 2018. The profit sharing ratios were as follows. So the first thing I'd like us to take note of is that we have the absorbing partner, which is A Associate, and then we also have the absorbed partner or partnership, which is E Associate, right? So the next thing is they gave us the profit sharing ratios. Moving on, after all the arrangements, John and Ugochi became partners in the newly formed A Associates. Given below is a statement of financial position of A and E associate respectively before absorption. So this is the financial statement of both businesses before they became absorbed, right? Because the reason why they give us this financial statement is because we needing it in order to make a new financial statement for the new partnership, right? So this is the previous financial statement. This is the capital of each of those partners. We have E associate and we have E associate. We also have their current accounts shown here. So let's move on to the adjustment. So I would like us to take notes of this adjustment. The first one, E associate received 63,000 from the credit customers and the balance remained bad and uncollectible. A enterprise accepted to take over 60% of the creditors of E associate, while the balance was to be paid by E associate. The assets of E associate were taken over at the following amount, meaning there was a revaluation, right? That's what it means. And then the next one is the balance in the bank account was also taken over after paying the credit suppliers. Inventory of E associate included obsolete inventory of 3,000. What is our requirement? Usually, we are meant to read a requirement before the question. So, like our advice, before you start a question, make sure you read the requirement. So, write up the accounts to wind up the records of E associate, prepare the relevant journal and business acquisition account to reflect the absorption due in the books of E associates. Prepare the statement of financial position as at 1st of January after the absorption, right? So, like I said, we have two partners, right? The absorbing partner and the absorbed partnership. So, right, the absorbed partner is going to be dissolved, and we need to account for that. How do we account for that? We account for that through dissolution, and the account that is created to account for that is the realization account, right? Now, if you notice in the question, it was said that E associate is the partner that is being absorbed. So, looking at the solution, we're going to prepare a realization account for E associate because it is the absorbed partner. And now, usually on the debit side of a realization account, we usually have the book values of the assets based from the we get our book values from the financial statements they give us in the question. And then on the credit side, you have your amount that you realized, right? The amount realized from the asset. So now let's go to the question or to the financial statement. Now, for E associates, these are the book values, like the financial statement values. And I said on the debit side, we have the book values, and on the credit side, you have your amount realized. Now we're preparing this account because E associate is going to be dissolved. It's no longer going to exist because it's been acquired, right? So we have to prepare an account to dissolve it. So the book values for plant and machinery is what? 15. That's how they go 15. Also in the question we have 40 as goodwill. So written here. Inventory 15. It's also written here. And then the trade receivables, it was also written here as 70. And then the bank, I'll come back to how they got their bank. Moving on to the credit side, we have the bank receipt from credit customers. Now, if you look at the adjustment, yeah, the first adjustment says that E associate, meaning the absorbed partner, received 63,000 from the credit customers and the balance remained bad and uncollectible. So let's go back to our previous financial statement, which says that the trade receivables of E associate was 70,000, right? And in the adjustment, they said they were only able to receive 63,000, meaning that's what they were able to realize from their trade receivables. And then the remaining 7,000 becoming a bad debt because they were unable to realize it. So therefore, we're going to record this here, as 63,000 because that's what they were able to realize from their sales, from their trade receivables, right? Then moving on to the creditors of 60%. Let's go to the adjustments. Yeah. So it said A Enterprise accepted to take over 60% of the creditors of E Associates, while the balance was to be paid by E Associates. Now let's go to the question. I need you to follow me carefully. In the question, this was the amount of creditors that E Associates had before the absorption took place, which was 12. And in the adjustment, it was said that A Associates was going to take over 60% of these creditors. Creditors also the same thing as trade payables. Now, if you do 60% multiplied by 12, you should get 7.2. And I said, based on this place is the credit side is the amount they realize, and so yeah, you're going to write 7.2. Now, purchase consideration. How did they get their purchase consideration? Let's look at the solution for purchase consideration. Now, this is how they got their purchase consideration. Purchase consideration is simply the assets taken over, right, minus what? The liabilities taken over. Once you do that, you get your purchase consideration. So let's see how they got their purchase consideration. I'd like to go back to the adjustments here. So the first one we have is plant and machinery. So notice that in the adjustment, they said the assets of E Associates were taken over at the following amounts. So plant and machinery was taken over at 30,000, not at the book value, which was 15,000, because a revaluation has occurred. So and I said that purchase consideration is simply your asset taken over minus what? Your liabilities taken over. So plant and machinery was taken over at 30,000, which we have here. Also, let's look at goodwill. Yeah, goodwill also was taken over at 40,000. So there was no revaluation for goodwill. It was taken over at the book amount. Now moving on to inventory. How did they get 12? Notice that in the question for inventory, we have 15,000. It wasn't taken over at 15,000. Why? Because in the adjustments, I need you to follow me very carefully. Sorry. Yeah. In the adjustment, it was said that inventory of E Associates included obsolete inventory of 3,000, meaning that the inventory were bad. So therefore, they cannot take over a bad inventory, obviously. So they have to deduct the value of that obsolete inventory from the book value, which was 15, and then they got an inventory of 12, which they're going to take over. Now, the bank, like I said, I was going to explain how they got the bank. Let's move on to how they got the bank. In the financial statements of E Associates, remember we are preparing first for E Associates because E Associates is going to be dissolved. It's the absorbed partner, right? The balance in the E Associates, in E Associates, their banks, their bank balance was 4, and that's why we have 4 here. Remember, bank account is an asset account, right? And assets are usually debited. So we have a positive or normal balance, which is 4, and this was what was recorded here. Moving on, how did you get their 4.8? Now, I would like to go back to the adjustments. Yeah. Sorry. Yeah, so let's go to the adjustments. Now, in this particular adjustment, it said A Enterprise accepted to take over 60% of the creditors of E Associates, while the balance was to be paid by E Associates. Now, A agreed to take over 60%. So, what's going to happen to the remaining 40%? It is going to be paid by E Associates. That's why it was credited here, meaning that their bank, they are going to give out money. Remember, when you're crediting, you're giving out value, right? So it means the remaining 40%, E Associates will have to pay it by themselves, and that's 40% multiplied by 12%, which will give us 4.8, right? And then remember, they also receive money from their trade receivables, meaning their customers. The amount of money they were able to receive out of 70,000 was only 63,000, and that's why we have it on the debit side, because it was a receipt, an income to them. Do you get? And after doing all those adjustments, our balance that's going to be taken to the revaluation account is 62.2. That's how they got the value of 62.2 here, and also that's how they got bank of 62.2 here. Now, why we taking over bank? Because it was stated in the adjustment that the balance in the bank account was also taken over after paying the credit suppliers. That's why it's being considered in realization accounts, because the bank account was also going to be taken over. Do you understand? Now, moving on, I've treated how they got the realization account, the purchase consideration, and their bank accounts. So the trade payable accounts, how do they get their trade payable accounts? Remember, in the financial statements, please remember that we are preparing for e-associates first. So all these accounts that we are doing up to this point is for e-associates, right? So the balance for the trade payables of e-associates was 12,000. Why? Because trade payable account is a credit account. Do you understand? And so that's why the balance was credited. Remember, bank account is a debit account. That's why it was debited. It's an asset. So it was credited. 12 was credited here, and then the realization of 60%, 7.2 was also recorded, and bank of 40% was also recorded, meaning that the trade payables, meaning their creditors, received money of 40% from e-associates. They paid their debt to these trade payable guys, so that's why it was debited as 4.8, and also 7.2 that e-associate paid. The trade payables, meaning the creditors, also receive this amount, and that's how we got our total balance, right? So moving on to the capital account. Yeah, so let's go back to the financial statements. So how did they get their capital account? Sorry. So the capital account for e-associate, we have John and Ugochi, which is 80 and 40. Capital account is a credit account, so it is usually credited, right? So they credited the account balances of John and Ugochi, which is 80 and 40. Also, we have their current account balances here recorded as 7 and 5. It's also a credit account because it's more like a capital account, right? And then one of the things that wasn't recorded here was I'm sorry, it wasn't recorded. I'm just noticing that was share of profits. So remember, after doing the revaluation, the partners will have a share of profits at the profit sharing ratio that was specified in the question, and then they share their profits, which was 3,000 and 2,000. Yeah, which was 3,000 and 2,000. So here we're supposed to have 3,000 and 2,000. When you sum everything there, you have a balance of 90,000 and 47,000. That's how they got their capital account. Moving on, they also asked us to prepare a associate account, right? So this purchase consideration is just representing the amount of money that a associate paid in order to acquire e associate. And then we also have the capital account here. So this is the value of John and Ugochi, like their capital account balances in the new formed partnership, because this is an e associate account. So it's just simply saying that this is the value of their capital in the newly formed partnership, which is a associate account. Now you can also do some journal entries in the books of a associate account. Yeah, so the plant and machinery was taken over at what? 30,000, because it was revalued from 15 to 30,000. So that's why we have 30,000 here. Goodwill too was taken over at what? 40,000. The bank was also taken over at what? 62.2 thousand. And then we have inventory. It was also taken over at 12,000. The reason why we are debiting this is because they are simply an asset. So the rule in accounting is you debit your assets and you credit your liabilities. So these four here were assets and they were debited. The trade payables also, because it's a liability, it was credited as 7.2. Remember that now this is in the books of A associates. A associates did not take over all of the trade payables of E associates. They only took over 60%, and 60% of 12, which was in the financial statement of E associates, was 7.2. So they took over 7.2, and that's why it was credited. This is in the books of E associate now, the uniform partnership. And then the capital account of John and Ugochi in the newly formed partnership is what? 90 and 47. All this came from the capital account. So this is being assets and liabilities taken over by A Associates as at 1st January 2018. So this is a journal entry, a simple journal entry. Now the main deal we're going to is the statement of financial position. Remember that in the question we were asked to, given below is a statement, in the question, prepare the statement of financial position as at 1st of January after the absorption. So remember we have a previous financial statement before the absorption, and then we have another one after the absorption has taken place. Now in this case, E associate is going to be like eliminated. It's no more existing. So like we're creating a new statement of financial position only showing A associate, because E associate is no longer existing. So the normal format of your statement of financial position, we have the assets. So firstly, the non-current assets. So it's more like a consolidation. So let me explain clearly. Now the first one is plant and machinery. So before the absorption took place, A associate had 85,000 as their plant and machinery. They are still going to have that amount of plant and machinery in the newly formed partnership. So the only thing they're adding now is 30,000, which was what they took over. They took over the assets of the plant and machinery of E associates at 30,000. So when you add that, you get 115,000. Now for the intangible assets, right, which is goodwill, in the previous financial statement we have 50 and 40. The goodwill was not revalued, so we just add the two, and then this is 90,000. When you do the addition of that, you get your total non-current assets, which is 205,000. Now for the current assets, remember that A associate before the absorption took place had 18,000. Now that 18,000, you're going to add it to what? 12,000, not 15,000, because they took over the inventory at what? 12,000. Remember that 3,000 was obsolete and it has been deducted, right? So they are taking over the inventory at 12. So when you add 18 plus 12, it's going to give you what? 30,000. That's the value that A associates took the inventory. For trade receivables, we have 140, right? So 70 was not added to 140. Why was it not added to 140? If you look at the question, it said A associates received 63,000 from credit customers and the balance remained bad and uncollectible. So it means there is no more trade payables for E associates, meaning that E associates has received the money due for trade receivables. So there's no more debt. They don't have any debtor again. And then the remaining 7,000, which was considered as a bad debt, it's totally gone, and so we don't need to record it. So the 63,000 and the 7,000, which makes up the 70,000 that was year before, is totally gone. So the only trade receivables now is that of A associates, and that's why we have 140,000. Now for the bank balance, this was the bank balance that A associates had before the absorption, which is 70,000. And then when they absorbed E associates, they had what? 62.2. And then when you add it together, you get this. This will now become your total current assets. Yeah. So now for the current liabilities, the same thing, the same concept. This was what this was the trade payables of A associate before the absorption, and then the 7.2 that they took over at 60% of the trade payables of E associate, which is 7.2. When you add that, you get 45.2, and then you get a net of current assets. Yeah, moving on, we're almost done with the statement of financial position. Now this is the equity side, or more or less the capital account side. So remember that in the previous statement of financial position, this is the capital account before the absorption took place. So now for Aba, Ada, and Afa, which is 180 and 60,000, right? Nothing happened to it, so it was just written here directly, 180 and 60,000. Now also their current account, which is this amount here, was also written here. Now for the new capital account, which we calculated earlier, if you look at the capital account, we check if you check the capital account, you see that the new balances for John and Ugochi in this newly formed partnership, which is ER sheet, is 90 and 47. So when you do the addition, it's going to give you 409, which is also equal to what we got previously as 409. So this is all we need to know on absorption.